Oil and energy prices are moving again, and whether they're rising or falling, they are quietly reshaping your portfolio. But here's the real question. When oil goes up, who actually benefits? When oil drops, who really gets hurt? And most importantly, what should you be doing about it? Because oil isn't just another commodity. It's the heartbeat of the global economy. And today, we're breaking down exactly what rising or falling oil prices mean for your stocks, your inflation outlook, and your long-term investing strategy. Stay with me, because the impact is bigger than most investors realize. Why oil prices matter more than you think. Let's start simple. Oil touches almost everything: transportation, manufacturing, plastics, chemicals, food production, airlines, shipping, electricity in some regions. When oil prices move, they don't move in isolation. They ripple through the entire economy. And that ripple eventually shows up in corporate earnings, inflation data, consumer spending, central bank decisions, stock market volatility. So when you see oil jump 5% in a day, that's not just an energy story, that's a macro story. Quick reality check. If you don't own energy stocks, you might still be heavily exposed to oil. Because if you own airline stocks, consumer goods companies, industrial stocks, transportation firms, even tech companies with global supply chains, oil prices still affect you. Now, what happens? When oil prices rise, let's break this down step by step. When oil rises sharply, here's what typically happens. 1. Energy stocks often rally. Companies involved in exploration, production, refining, oil field services usually benefit from higher prices, at least in the short term. Profit margins expand, cash flow improves, dividend potential increases. This is why energy stocks often outperform during oil rallies. 2. Inflation pressures increase. Higher oil means higher gasoline prices, higher shipping costs, higher production expenses, and that feeds directly into inflation. When inflation rises, bond yields may increase, central banks may delay rate cuts, growth stocks may face pressure. See how this spreads? Oil, inflation, interest rates, stock valuations. That's the chain reaction. 3. Consumer spending can slow. Here's the subtle impact. If consumers are paying more at the pump, they have less disposable income, and that can impact retail, travel, entertainment, consumer discretionary stocks. So while energy companies may benefit, other sectors might feel pressure. But here's where it gets interesting. Sometimes rising oil is actually a good sign for markets. Let's talk about that. When rising oil is bullish, not all oil price increases are bad. If oil is rising because global demand is strong, economic growth is accelerating, manufacturing is expanding, then it can signal economic strength. In that scenario, energy stocks rally, industrial stocks benefit, commodity producers gain, broader markets may stay supported. The key difference? Demand-driven rally versus supply shock rally. Demand rally, growth optimism. Supply shock rally, economic stress. And markets react very differently to each. Let me simplify this. If oil rises because the economy is booming, bullish. If oil rises because supply is threatened, risky. Same price movement. Completely different market impact. What happens? When oil prices fall. Now let's flip the script. When oil drops sharply, most people assume that's good. Cheaper gas, lower costs. But in markets, it's not always that simple. One energy stocks can struggle. Lower oil prices mean reduced profit margins, lower revenue projections, spending cuts from producers. Energy companies may underperform during sustained declines. If you're overweight energy stocks, this matters. 2. Consumers benefit. Lower gas prices increase disposable income. That can boost retail, travel, restaurants, consumer discretionary stocks. Cheaper oil can act like a mini tax cut for households. Inflation may cool. Falling oil prices reduce pressure on CPI data. That may lower inflation expectations, reduce bond yields, support rate cut expectations, help growth in tech stocks. This is why tech stocks often rally when oil falls sharply. But here's the twist. Sometimes falling oil is actually a warning sign when falling oil is bearish. If oil drops because global demand is collapsing, recession fears are rising, industrial activity is slowing, then falling oil becomes a risk signal. Markets might interpret it as economic slowdown ahead. In that case, energy stocks drop, cyclical stocks weaken, broader indices may turn volatile. Again, context matters more than direction. Oil and the Federal Reserve connection. This is where things get strategic. Oil impacts inflation. Inflation impacts Federal Reserve decisions. And Fed decisions impact nearly every asset class. If oil spikes and inflation rises, the Fed may stay hawkish longer, rate cuts may be delayed, Bond yields may rise, growth stocks may struggle. If oil falls and inflation cools, the Fed may pivot dovish, rate cuts may accelerate, risk assets may rally. So watching oil is partly about watching the Fed's future moves. Oil is a leading indicator for inflation trends. Let me ask you something. When you check stock prices daily, do you check oil prices too? Because big money does. Oil's impact on different portfolio types. Let's break this down practically. If you're growth heavy, you want stable or falling oil, cooling inflation, lower yields. That environment supports higher valuations. If you're value or dividend focused, rising oil may help. Energy stocks, industrial companies, materials sector. But you still want to watch inflation risk. If you own commodities, oil often moves in tandem with natural gas, copper, broader commodity indices. Higher oil can lift the entire commodity complex. If you own international stocks, oil prices affect emerging markets, oil importing countries, oil exporting nations. Some economies benefit from higher oil, others suffer from it. So global exposure adds another layer, the currency factor. Oil is priced in US dollars. So if the dollar weakens, oil often rises. If the dollar strengthens, oil can face pressure. That means your currency outlook also influences energy exposure. This cross-asset relationship is where advanced portfolio strategy comes in. Are we heading into an energy supercycle? Some analysts argue underinvestment in oil production, ESG-driven capital constraints, geopolitical tensions, supply discipline from producers could support higher oil prices longer term. Others argue slowing global growth, renewable energy expansion, demand moderation could cap upside. The truth? Oil markets are cyclical, and volatility is normal. What should investors do? Here's your framework. Don't react emotionally to daily oil moves. Instead ask, 1. Why is oil moving? 2. Is it demand-driven or supply-driven? 3. What does this mean for inflation? 4. How might the Fed respond? 5. Which sectors benefit or suffer? Oil isn't just an energy story, it's a macro compass. If you understand oil, you understand inflation. If you understand inflation, you understand rates. If you understand rates, you understand markets. Now I want to hear from you. Do you think oil is headed higher, or are we about to see a cooling trend? And how exposed is your portfolio to energy right now? Drop your thoughts in the comments. And if you found this breakdown helpful, make sure you subscribe, because understanding macro moves before they hit headlines is how long-term investors stay ahead.